Good morning, everyone, and thank you for joining us on today's webinar to discuss the current production trends in the U.S. oil and gas market and the outlook for the MLP asset class. My name is Will Hershey of Yorkville Capital Management, and joining me on today's call from Yorkville will be Darren Sharinga, Founder and Chief Investment Officer. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box in the bottom right corner of your screen. We will hold a Q&A session at the end of the call, and we'll do our best to answer everyone's questions. With that, I will turn the call over to Darren for his prepared remarks.
Thank you, Will, and thank you all for joining us on this summer morning or afternoon, depending on where you're calling in from. The MLP and a lot of questions that we've been getting as a firm here and the debate that we see going on with investors, both high net worth individuals as well as institutional investors, is this real? Has a bottom been put in the energy market specifically, and then more generally, and then more specifically to MLPs? And we'll make the case that says we do believe, based on fundamentals, that a bottom has been put in, and this is a real rally that we're experiencing, and that will be sustainable, again, because it's fundamentally based, not based on sentiment, which sentiment, as we all know, is very fickle. It can change rapidly. So the second quarter in review, most of the numbers I'll be speaking to here for this next section will be based on June 30th or through June 30th, 2016. Well, in terms of quarterly returns, is this a real bottom? The second quarter of 16 ending, again, June 30th, was the top quarterly total return in the history of the MLP asset class, which really says something. MLPs returned 21% for the quarter. This number is based on the Yorkville MLP Universe Index, which is a market cap weighted index that tracks the entire population of MLPs. And part of our job here as MLP experts is to educate investors on the MLP asset class, and we created our universe indices to do that, and really to do that and create a more accurate way of tracking the asset class, because we look at the entire population. So all MLPs are covered in the universe index. What else is interesting from this slide, if you look down, the third, fifth, and 10th best performing quarters were in 09. And 09 was post the Great Recession of 08. So that was the MLP recovery coming into 09. Now what we've experienced here, and Q2 was the first, I'm not saying this is a parallel of 09, but Q2 is the first and the best performing quarter in 09. We just came out of the Great Recession, Great Energy Recession of 2015, and the fact that more people aren't cognizant of it, because a lot are not energy investors, and we're investing in the S&P, which is reaching all-time highs. So when we look at energy going forward, outside of the bottom being in based on fundamentals, we see some of the greatest values of investment opportunities globally coming out of the energy space in 2016 and 2017. Let me put the caveat out there. If we're right, if the bottom has been put in, most sectors in the U.S. right now are trading near all-time highs based on at absolute levels, as well as when you're looking at their multiples. So what's the room for multiple expansion? It's either going to be earnings growth or multiple expansion, whereas energy has been hammered and is coming off the bottom right now, trading nearer trough multiples, definitely at the lower end of its absolute trading range. So we're very excited about energy right now, not only because we're energy investors, we felt the pain over the last couple of years, but we see a great opportunity here going forward. So if you recall, and let me not make the assumption anyone does, this next slide entitled Growth MLPs Lag in 2016. Part of our index work that we've done in creating our universe indices, first of all, we tracked the entire population, then we broke them into two halves and looked at commodity MLPs and infrastructure MLPs, with the argument being not all MLPs are created equally, because there's a very different business model between an infrastructure company and a commodity company. So that was work we did many years ago. Recently, we came out and segmented the asset class further. Well, we created 10 sectors. It's more work, but we segmented it by growth and value. And when you look at growth MLPs, which, again, if you remember, Yorkville is the growth manager of MLP investing, and we believe that growth is the investment thesis that underpins MLPs, because it drives total return and your growth of distributions. If you look at growth, though, relative to the MLP Universe Index currently in the second quarter, which is your first bar chart on the bottom, the universe, or the asset class, was up 21%. Growth MLPs were up half that, 12% basically, a little better than half. It's more pronounced when you look at it on a year-to-date basis. So through the first half of the year, MLPs were up 14% as an asset class. Growth was up 5%. So negative 9% performance from the asset class relative to growth. What we've seen here is a common phenomenon. It happened as well, and it happens generally when we're coming off the bottoms. Some people call it a junk rally. We saw it again in 08 coming into 09. We're seeing it again here in 16 repeat itself so far. High-yielding plays that represent greater value, that now have made it to, were priced for bankruptcy risk, ultimately have come through, that the bankruptcy is not going to happen in the worst-case scenario. We're priced for distribution cuts. It doesn't look like they're going to cut distributions. The income is now safe. These companies represent the greatest value on a historical basis if they aren't going bankrupt, if they aren't cutting their distribution, and they generally outperform coming out of the bottom, with growth then catching up afterwards as the cycle continues to expand, as we believe it will here. Infrastructure, MLPs. So this is, again, we're not looking at commodity, we're looking at infrastructure solely. These are companies involved in the transportation and storage of fossil fuels, whether it be oil, natural gas, or distilled product. They showed a stability score, which is really quality of the income. 91% of all infrastructure MLPs maintained or increased their distribution in the second quarter of 2016. The growth score, which is quantity, how much did they grow their distribution? Clearly, you don't want distribution shrinking. That's very bad. It's taking money out of your pocket quarter over quarter as investors in MLPs. Distribution growth was at 8.4%. Clearly, if the S&P 500 is growing earnings at 8.4%, everyone is pretty happy with the overall growth of earnings. MLPs coming out of this downturn, and really infrastructure MLPs through the downturn, once again exhibited high-quality income and growing income based on their leasing business model. So, again, an asset class that is healthy and has withstood the great energy recession of 2015, as it did similarly in 2008. Asset class performance in the second quarter, we always like to look at where investors have and can place their capital, what alternatives they have in the marketplace. If you look at so we look at income alternatives. We look at REITs and utilities, high yield, and then we look at equities, S&P 500, and then the risk-free 10-year Treasury. So MLP Universe, as we stated earlier, the best quarter in the history of the asset class, up 20.8%. We see that this is a bottom that's been put in the asset class. The bottom, if we again are correct, will be February 11th of 2016. That was the bottom in oil, bottom in MLPs. The markets are pretty efficient when you look at it on a long-term basis. I think there are vagaries on a day-to-day basis, but overall, they are a pretty good weighing mechanism of quality. When you look at low interest rates, quantitative easing, negative interest rates, areas that central banks have never gone before to stimulate economic growth, that leaves investors with this need for income. And so there is a global quest for yield right now, and I think that shows up in all of your high-yielding investment alternatives. MLPs obviously the best, up 20%, but REITs had a strong quarter, up 7%, utilities up almost 7%, and high yield up 6%, significantly outperforming the S&P 500, which was up 2.5% for the quarter. On this next slide looks at yield, and as you can see that high yield is where investors are going to get the most amount of current income, followed closely thereafter by MLPs. We love to point out this difference between high-yielding bonds and MLPs. There's no growth in income coming out of a bond, whereas the MLPs are equities, are their operating companies. that are growing their distributions over time. In fact, in the most recent quarters we pointed out, they grew their distributions over 8%. So the rule of 72, you're going to double your income in roughly a little less than 9 years based on that math. So that is, in high yield will not give you that type of growth in income. So the MLP universe, 7% current income. Compare that with REITs and utilities, 4.2%, 3.3%. We believe that this spread of 3 to 4% that investors pick up by buying MLPs over REITs and utilities will be a driver of investor demand going forward in the balance of 2016 and into 2017. REITs and utilities on historical basis, a yield basis, are trading at the higher end of their historical trading range. MLPs are really trading at the middle of their historical trading range on a spread basis at the higher end of its trading range. So, but just the uptick in income, 3 to 4% per annum, that's incredible coming out of the MLP asset class. And again, if growth is at 8 to 9% coming out of the trough, imagine what it's going to look like as we start to get into a growth phase of MLPs again as production starts to increase again coming out of the U.S. So that completes my comments, or our comments as a firm on the second quarter, and looking at it in summary. MLPs had the best quarter in their history. And that's coming out of the great energy recession of 2015, coming out of the great recession of 2008, global recession. MLPs put together 3 of their best quarters in 2009 in the top 10. We'll see what happens in 2016 to the asset class, but so far the second quarter is looking pretty good and indicative of Yorkville's thesis that a bottom has been put in. So U.S. oil production trends, why is that important? Because the reason commodity prices collapsed, and collapse is exactly what they did. That's why it was catastrophic, as bad as it was in 2008. It was for energy investors in 2015, whether it was commodity prices, the action of stock prices dropping, but for different reasons. In 2008, you had demand destruction, and in 2015, you had oversupply of energy. So there was more supply than there was demand. And why was that? The U.S. energy revolution. And I think investors are starting to forget that the U.S. energy revolution is real and is in place and is actually just in the first few innings of where it's going. So the U.S. energy revolution led to global oversupply. Yorkville's thesis here is that the global oil markets will organically rebalance themselves this year, or in worst case scenario, the beginning of 2017. The caveat there would be if there's demand destruction, then that would change the outlook to oil prices, because now we're back to an 2008 scenario. So why is the market coming in why are the global oil markets rebalancing? U.S. production declines. That is the primary reason. So, and that gives us, and that's why we say it's a fundamentally driven rebalancing, and that's why we think it's sustainable here, our thesis, because it is not sentiment driven again. You know, oil production, as we'll touch on in these next few pages, has come down dramatically in the United States. Again, given that these are capital market driven economies. So let's flip to the first slide here. U.S. oil production decline, peak to present. Well, we peaked at in the U.S. 9.6 million barrels, a little over that actually, and currently we're producing 8.6 million barrels. So we're down a million barrels. Let's just look at the 9.6 million barrels for a moment. That reverse production declines, a trend that was in place since the mid-'80s. U.S. production was declining. Interestingly enough, MLP distributions over that period were still growing. Anyway, we got to the mid-2000s, and with new technologies, we were able to open up a whole lot of new basins profitably to produce oil and natural gas from. Our output reached 9.6 million over the previous 3 years, leading into 2015. All of the new oil production that came online globally came out of the United States, which is incredible. We, at 9.6 million barrels, we're the second largest oil producing country next to Saudi Arabia. So the theme here is the U.S. energy revolution, as I said earlier, is real. We are the largest and will continue and grow more powerful as the largest energy producing nation in the world, both in terms of oil and natural gas, which is a very powerful position to be in on a global basis. So anyway, to the rebalancing, fundamentally, we dropped in the U.S. our production levels in oil by 1 million barrels a day at 8.6 million. That number is still not turned up, and we wouldn't expect it to turn up for a little bit, but there are signs that it will turn soon here. What and we'll touch on those signs in a moment. The next slide looks at U.S. oil production by basin, and here it's interesting because not all basins, like not all MLPs, are created equally. And as you can see across the basins, not all declines were equal. And why is that? The difference is really the cost structure per basin, and some of the basins are simply more expensive than others to extract oil and natural gas from. So when you get into a downturn and the commodity prices decline, what do? You go to your basins that are your cheapest source of oil or natural gas. So as investors, that causes us to focus on these basins and to direct your assets from an active management into where we believe, A, we get the most protection on the downside, but B, we'll get the first participation in a cyclical upswing, which again we believe we're in, and we'll talk on more of the signs here currently. So if you look at it, and obviously if I was to ask the question out there, what basin looks to be the best, you probably all say the Permian, and you'd be correct. That is one of the most attractive basins from an economic standpoint due to the low cost of production. And you can see although production declines have been 1 million barrels in the U.S., through current, Permian has remained relatively flat. And then the other basins, Eagle Ford, Bakken, Niobrara, they've all had declines of mid-20s to mid-30% over this time frame. Not to say any of the basins are bad, it's just relative. Some of them are more expensive. So what we're doing as active managers, we're positioning our portfolios, and have been before this slide presentation today, on how can we participate in these regions that have been getting the investment, and we believe we'll get the first investment coming in. And how do we measure the first to participate in the cyclical upswing that we believe we're in the midst of right now? Well, that's drilling activity. So as you can see on this next slide, which is total rig counts, it's really a simple equation here. You need to drill in order to increase production, and the way you drill or measure drilling activity is through rig count. So rig counts dropped from a little over 2,000 to under 500, 76%. We witnessed and experienced a similar decline back in 2008. So we've been here before. This is a repeat a few years later. So great energy recession of 15, rig counts down 76%, production down 1 million barrels, drilling activity leads production. So we're very focused on where the drilling activity is taking place or coming off. As you look at the basins again, rig count by basin here, we picked the top 4 basins is why there's only 4 of them. There are more basins in North America, but these are the most prolific. Production or rig counts are down across all basins, and there's a few factors coming in here. One is productivity. We're more productive in the drilling we are more productive per rig in drilling in the amount of oil or natural gas that we can extract per well, which is really important, and that productivity is lowering the cost of energy production out of the U.S., which is a key piece in the overall U.S. energy revolution theme. We're not only the largest energy producing nation and will continue to grow that way, our costs are coming down dramatically as our productivity increases on a rig basis, so that we will be the low cost, and we are currently the low cost marginal supplier of oil on a global basis. And as you recall, this past year we actually lifted a ban on oil exports. So we are now actually an oil exporting nation as well, which is another piece of this equation, which is all exciting in supporting the U.S. energy revolution. So oil rig counts, sustainability, is this real again? And that's the question we get, or is this like August of 15 and it's a head fake and we're gonna get burned again by putting our toes back into the MLP marketplace or to energy? We believe it is, and here's another difference, is rig counts are bottoming. So mid-May, a couple of months after the price of oil bottomed in February, March, April, May, 3 months, you saw rig counts bottom. And through current, they're up 19% from the bottoms, which is still a relatively small number. Again, look at where they've come on. And the first activity, again, positioning the portfolio, looking for companies that are going to benefit from the first production growth, meaning the first potential for distribution, for EBITDA growth, and ultimately distribution growth. The Permian region, that was 50% here through June of new rigs that went on in the Permian. Everywhere else was flat. So it just supports our thesis of production of the Permian flat, rig counts drop, new rig counts coming back on or going into the low-cost basins first, and that's why you want to be positioned there to maximize your value and return potential in the asset class. This next chart is really graph is looking at WTI, the green line, versus rig count, the silver line. And as you can see, what it clearly demonstrates, the price of oil is a leading indicator of rig counts. Oil drops, drilling activity slows, because it's not as profitable to bring oil out of the ground. So what you can see here again, I keep mentioning it, February 11th, the bottom, which is what we're calling oil at around $26 a barrel. Got up over $50 a barrel to its most recent high. Then we witnessed a pullback here, just around 40, a little below 40, and now we're back in the mid-40 range again. I know, almost pushing 50 today. So again, we believe this is not driven by sentiment, not driven by speculators, which is a low-quality rally, albeit a rally. This is driven by fundamentals. There is global rebalancing taking place of the primary problem, which was oversupply from the United States. The United States supplies is coming offline, but by the magnitude of 1 million barrels so far. So looking at how Yorkville has weathered the storm right here, and the fact that we are the growth investors in MLP investing, it's been a hard period for us and for our investors in terms of relative underperformance. Fundamentally, though, we are sticking to our knitting, and as you can see, our stability score stays at 10, which means 100% of the names in our portfolio in the second quarter maintained or increased their distribution. We had growth across the portfolio of 8.2%, which is in line with infrastructure, far better than what MLPs did overall, as I'll touch on in a moment. The yield of our portfolio is still sitting around 7%, which is in line with the overall MLP universe. It's actually a little above the universe. We believe we have ourselves positioned for greater growth going forward in the names we put in the portfolio as some of these companies start to benefit from increased drilling activity. We would imagine our growth rates get revised up over the next couple of years. Distribution growth rate relative to the MLP universe. Why this is a negative number relative to the infrastructure, this looks at commodity MLPs and is a simple average. And so there were a lot of commodity MLP companies, again, different business model, commodity exposure versus in the infrastructure and leasing. A lot of commodity MLPs cut their distributions. So overall, on average, MLPs had distribution declines in the second quarter, driven by the commodity segment of the asset class. We often talk about this because, again, it's our thesis. It's when you look at it back in the envelope, what's your current income plus your growth in income, equals your total return potential without multiple expansion. So and we're looking at yield of 7%, distribution growth of 8.2%, gives a total return potential. Again, back to the envelope, we're not promising these numbers of 15%, above what we, based on this simple formulaic approach to the marketplace. Moving forward to the last slide of our prepared remarks, it has been for Yorkville and for growth MLPs one of the worst periods of underperformance relative to the broader MLP marketplace and the Alarian Index, which is the most broadly followed MLP index. So if you look over the past year, we've actually underperformed the index through 6/30 by 10%. That's a terrible negative alpha. Moving ahead 5 years, if you've been with us, we're looking at, on a gross basis, over 6.5% positive alpha per annum. And keep this in mind, we're coming to you humble with our worst performance numbers, and we're delivering this alpha. Now, when we start to catch up again, our alpha expands dramatically if we start to catch up again, which, since we've done nothing differently and we believe we're at a fundamental bottom, I think that there is growth MLPs will catch up again to value. As that spread narrows, growth will become more highly valued, and Yorkville should do well. So, in conclusion, we believe that a bottom has been put into the market, and that bottom will turn out to be, looking back in history, February 11th, 2016. And number two, why do we believe that, and that this rally is real and sustainable? Because it's fundamentally driven. We're seeing supply come offline. Number three, why MLPs, because of the high current income that's growing. We believe that will be very attractive to investors within the MLP asset class. We believe growth is positioned to outperform over the next up cycle as it has historically. So if history repeats itself, growth should deliver better returns for investors. If Yorkville is able to repeat itself, we would say we're the growth managers within the MLP. It's been our expertise. We've always looked at this as a total return investment, that we should be able to deliver returns that are whatever they may be. I can't promise anything. So we're excited to hear your questions. I'm going to turn the call back over to Will again. I really appreciate your time today and sitting down and listening to us. We think this is an exciting opportunity to be in MLPs, and it's it should mark a great entry point. So Will, back to you.
Great, thank you. Thank you, Darren, for the informative presentation. With that, as Darren mentioned, we will now begin the Q&A portion of the call. As a reminder, if you have any questions you would like addressed, please type them in the text box in the bottom right corner of the screen. We have a few already, so let's get started. First question comes in, what does Yorkville expect out of the OPEC meeting scheduled for next month? There's been a lot of talk and headlines about a potential production freeze, and the question asker makes a good point. If we're at such high levels, does it make a difference?
Okay. So, and that's a good point. When another argument or an argument that we've made and an observation based on observations has been that OPEC countries have been incentivized to maximize their production. Why? Because most of them, to balance their budgets, oil at 20 definitely doesn't work. Oil at 40 doesn't work. And if you look at the numbers that I've seen, even for Saudi Arabia, it's oil of $100 works to balance their budget. So most are running running deficits now, and at current oil prices. So what do you do if you need hard currency to fund wars, to buy supplies, to do all of these things? You pump more oil. You're incentivized to maximize your production levels. So we've seen that on a global basis because that brings in the most amount of hard currency. and that enables countries to pay their bills. So we think that what we've witnessed on a global basis is that most countries outside of rhetoric are producing at maximum levels, which again fundamentally is what gets us excited about the story where we are right now, that we don't think there's a lot of latent capacity to come back online. I think Iran would be one country that has, it's a few 100,000 short of its peak levels, pre-sanction levels. So outside of that, we don't think there's a whole lot of capacity to come online, number one. So everyone's been incentivized, countries have been incentivized to produce at maximum levels and have. Two, that we have seen on a global basis last year that exploration done has produced new reserves at the lowest levels in 50 years, Will, I believe that the number was?
Roughly, yep.
So there's been such a little investment globally in finding new reserves to replace existing production and existing reserves that the decline rates should even be, or potentially may even be greater coming into the latter part of 16 and into 17 than the global markets are anticipating right now due to lack of investment. And we can see that. I mean, look at drilling activity in the States, look at global investment in energy. It's dried up and it's starting to come back online right now. So maximize production levels, underinvestment in new production on a global basis. A freeze right now, I think optically it's good, and it puts a theoretical cap on oil production, and when we're running numbers now and analysts are running numbers, we can look at it and say, okay, if oil production is capped at X and demand is Y, we're at a balanced market, this is good. It provides more certainty if no one cheats, right? That becomes the other part of it, but optically it looks good. Again, for us fundamentally, we said this through the first OPEC freeze that with Saudi Arabia, with Russia, sorry, that didn't happen. It doesn't matter. The markets are organically balancing themselves, and it'll happen this year and maybe into the beginning part of 2017. But this is a natural process that's going to take place. So I think it's a net positive if something happens. Don't get me wrong. I think that would be good. And if it doesn't happen, I don't think oil goes back to $26 because, again, fundamentally the markets are rebalancing themselves.
I think that's a great point. And you bring up kind of the concept of sentiment and how sentiment's played into part of the rally that we've seen thus far in oil, with the words of OPEC oil ministers throughout the world having a similar impact on oil as the Fed does on the overall equity market. It's been interesting to see that the sentiment really has been a driving force here. Kind of on a similar note, given the production declines that we've seen out of the U.S., do we think that the U.S. has kind of taken over the role of swing producer in the country the way the Saudis were a decade ago?
Yes. Yeah, fully. I think that the OPEC's influence on a global basis has been clearly diminished. I don't think it's clearly not. It's still extremely important and very significant. But the U.S. is the swing producer now, and I believe, and as a firm, we believe that the marginal price of oil will be set by the U.S. And how will it be set? Based on fundamentals. What is the cost of production of the U.S.? So that would be sort of the base of it if we have a balanced market. A whole bunch of assumptions need to go in, but if we have a balanced oil market, the cost of production out of the U.S. will set the market or above it if OPEC holds production back again. So that in the United States, what's happening, given productivity enhancements, a comment I made earlier in my presentation, is that we are, through new technologies, able to get more of the resource. So what does that mean in English? More natural gas, more oil out of a reservoir today than we were a year ago. And as we are able to do that in the same field, all of a sudden our cost goes down. So if there's a million barrels and we're able to, or 10 million barrels, and we're able to get 1 million barrels out right now, and that shows a profit, and all of a sudden we can get 2 million barrels out, in essence, our costs are getting cut in half, and if we can go from 2 to 4, our costs are getting cut in a quarter. So the United States is in this beautiful position of Moore's law happening, which is computing power increasing and prices getting cut. Our recovery rates are increasing and our prices are dropping, so no one's going to be able to compete. And offshore, and that's why we've seen a lot of bankruptcies and major offshore projects halted. We have 50 years of reserves here in oil and 100 years of reserves in natural gas based on our current consumption rate. So we have a plethora of fossil fuels that we can pull out of the ground, over time that are and there are decline rates naturally around the world too for more expensive oils that the U.S. will step in and be this marginal producer, which is part of really the macro story that makes the U.S. such an interesting place to be allocating capital to, and specifically in energy investments, whether it's on the safer side with infrastructure or even E&P companies going forward.
Yeah, it's a very great point, and I think you alluded to earlier, which further sets the U.S. as a swing producer, is the fact that they're kind of the only rational economic player in the room, if you will. You have a large majority of the OPEC nations that have, budget deficits to fight with, where they really can't cut back on production even if they wanted to, whereas the U.S. is going to come off when it's time to come off with production and bring it back online when it makes economic sense to do so. Moving on to our next question, is there any concern of distribution cuts for infrastructure / midstream MLPs going forward? I'll take a stab at it, Aaron, if you don't mind. I think while there's always potential, and certainly if we have another move in energy prices back down to where they were, we're not taking anything off the table. But I think we believe that the large majority of the damage from that perspective has been done. We've seen some of the larger cap MLPs take the necessary steps to address the concern. We saw it with Williams, we saw it with Energy Transfer, we saw it with Plains, we saw it with some other players that are rolling up into their general partners. But I think we didn't see many distribution cuts on the infrastructure side, and I think we're likely to not see many more, if any, additional cuts coming forward. On a different note, and this relates to some of the weaker MLPs. We do focus on all MLPs, so this is a fair question. Will there be any upstream MLPs that end up surviving? And on a similar note, do E&P or upstream, does that business model belong in an MLP wrapper?
So both are worthy of further exploration, and the surviving the commodity model is questionable whether it works in MLP if because of this, it's not stable growing distributions, and it's commodity. It's volume times price equals revenue, and so if price drops, it has 76%. Your revenue just drops 76%. Your profitability just gets wiped out at that point. I mean, any business can't afford revenue drops of 76% with a fixed cost structure and produce any profit. So there's clearly more volatility to income. So if MLPs are income-producing vehicles, no, it doesn't work. It doesn't really work in an income-producing vehicle. One simple answer. The second is, it may work for this reason. If you're looking to play commodity cycles, you're going to get more operating leverage out of a company that's distributing, 80% of its distributable cash flow, and you hit the commodity cycle right. So at that point, if you're looking to play a commodity upswing in a company and you don't want management reinvesting it in businesses it doesn't belong into and destroying capital going forward, or the potential to destroy capital, you get a lot of operating leverage and income that these partnerships will produce and provide distributions to you, so give you your income back. And we've witnessed commodity plays when they're gushing, no pun intended, produce a ton of cash. So you can take a lot of your initial investment out in cash and then still get the price appreciation. We did a study on this once that compared C Corp structures and MLPs. The price performance was pretty much the same, but you got all the income. So your total return was much better from an MLP when you timed it right. Now, that's a different investment again. That's timing, but it does provide a better, or the potential for a better total return profile. So that's on, there are different risks, I guess really would say that, and opportunities, okay? The other one, are E&Ps going to survive? Not many. Yeah, most are going to get wiped out. And yeah, not many. But there will be survivors, and so that's a greater risk, because it's not as now that you can wait and your principal's safe. Now you have a real risk of losing principal, and from an investor standpoint, that is the greatest risk we have, zeros. I mean, that's the worst case scenario. So any company that has that potential on a risk scale needs to be, at the top of the chart. So again, risk opportunities, some are going to survive, yes, but E&P, MLPs, E&Ps in general have been really hurt. MLP, E&Ps have been hurt even more so.
Yeah, exactly. And when you look at it, you mentioned the business model, price times commodity. That certainly doesn't lend itself to paying a stable, let alone growing distribution quarter after quarter after quarter. I would offer potentially we may see a reincarnation of E&P MLPs down the line that go down the variable distribution route, where they only pay what they can really afford to and don't go over their skis necessarily. Next question is kind of similar in some ways, but more generally speaking, were there any common mistakes made by MLP management teams in the downturn that we should kind of look out for next time, because there likely will be a next time that we have a decline in energy that we've seen? Are there any common mistakes that we should look out for? I'll take a run at it, and Darren, please step in.
Sure.
I think a few things kind of were general themes without going into too much detail. Clearly, you have individual companies that have risks and things associated solely with them, but I think a couple things. What you saw in 2014 and really at the peak boom of the build-out of infrastructure and new oil and gas basins in the United States was potentially too much leverage being taken on by some of the managements, not being as prudent in terms of their balance sheets from a leverage perspective. That's one. And then two is distribution coverage. So something that we've heard on conference calls this quarter and in previous quarters is likely a shift that we'll see out of many of the MLPs to no longer kind of just covering the distribution, but rather adopting more of the Magellan enterprise type model, where you have a buffer of coverage for this kind of a scenario, and you don't get caught without having anticipated this kind of decline and having to do something to cut your distribution or simply just to see unit prices decline. But I think those are two of the main.
I would wholeheartedly agree, because if you look at the remedial action that was required of management teams post the great energy recession of 2015 was shoring up the balance sheet. So ultimately, what had to happen, and the rating agencies were on this, was the management teams needed to bring down leverage, and there was only a few levers that they could pull to do so. Cutting distributions was one, lowering growth CapEx plans was another, and it all becomes exacerbated when you are into a low growth environment, when your EBITDA isn't there and you're generating sufficient free cash flow to funnel some of that towards paying down debt. So that's when we started to see different types of instruments being introduced to the capital structure, to lower leverage. So to Will's point, it all really focused around too much leverage, low coverage ratios, that from an investor standpoint, what we witnessed here, and we were aware of it, was, again, the positive growth of distributions. Management teams were almost became solely focused on that, and the market rewarding that so much that the concept of quality of growth was lost in the equation. And as leverage was increasing, as coverage ratios were getting tight, the markets were letting it slip by, whether it was the rating agencies or the equity investors. In the end, this is what happens in free markets, right? And so, but at this point, I think as it relates to more bankruptcies and quality, the balance sheets have been shored up, and so the capital structure has been cleaned up, and more of what we're hearing from management teams now, and it changes so quickly, even with infrastructure, which doesn't get built out very quickly. It takes years, and its useful life is years, right, decades, that it's now more of a focus on where are our growth opportunities again. So again, just listening to management and what's going on in the calls and speaking with them, that's how it's changing from surviving, cleaning up our balance sheets, to now, okay, where are our growth opportunities again as we look forward. And that's also an indication, more sentiment driven, but that management who is even closer to the operations than we are as investors is really coming out and saying we're looking towards growth in the future. So again, a real bottom, fundamentally, sustainability, because you're not going to put capital and start investing in multi-year projects unless that there is, forecastable demand coming from these areas.
Incredible how quickly things can change. Just 6 months ago, we were at $26, and we were wondering if we were going to hit the teens on WTI. So we've come a long way, to say the least, especially with the best quarter ever for MLPs. Next question, I don't want to go too far down this rabbit hole, but what kind of political risk do we see with the election coming up and Hillary Clinton's negative stance on fossil fuels? Is there a risk that fracking regulation really puts a damper on MLPs, but more broadly, it would affect the overall energy industry?
I think marginal. Honestly, I do, and so I don't think that the election, whether it's Hillary Clinton or Donald Trump becomes our next president, I don't think it's going to swing. I don't think if it was Trump, it would be a boon to energy, and I don't think if it's Clinton, it's going to be catastrophic. I think to a degree it's business as usual. We have a base load demand for electric generation that requires X amount of inputs of natural gas. To fuel it, we have fuel consumption that we're seeing, increasing efficiencies, which is good for cars, so that ultimately, looking forward, you have even a demand decline in the United States for fossil fuels, because fuel efficiency going up, electric cars playing to that. And a lot of the longer term demand is we have a more mature economy, clearly, is demand declines, and we've even seen that with switching from coal to natural gas. Unlike in the United States, our CO2 footprint from electricity production has declined, which is wonderful. I'd like to see more of that. And in Europe, it's gone up, because when Germany shut down their nuclear reactors, basically, they had to go to coal-fired plants, and so emissions in Europe have gone up, which when I'm in Europe, I point that out quite frequently, because we're always criticized here as being polluters in the United States. So I think the elections, there are trends that are in place. There's nothing that replaces base load demand right now. There's nothing that competes at this level. When I speak to my friends in renewable energy, it's really the biggest problem is how can we make it competitive and from a pricing standpoint. And right now it needs to be subsidized. There's just nothing that competes with the price of oil or natural gas. So I hope we find more uses for natural gas, being it's a cleaner burning fossil fuel. That would be great because it would be good for the country. I think keeping fuel costs low in the country is wonderful for jobs, and it creates, in full employment, which is something we really need here. So I don't think it matters who really wins. I think there are trends that are in place. They're going to continue to remain in place, and again, the election is sort of a non-event in the overall energy, and especially on a global basis. That outside the United States, where demand is the swing factor and really growing in developing nations, that we're not going to control, and now that we export, we'll actually be able to meet that demand going forward. And LNG exports, right? That's brand new for the United States. Just started to export our first liquefied natural gas, and that's a whole new market that's opening up to us. So there's a lot of different demand drivers fundamentally, and then along the Gulf Coast, because of the amount of the real energy revolution took place in natural gas in the United States. That's why we have a 100-year supply of natural gas based on current demand. So a lot of petrochemical plants were built along the Gulf Coast, which is the first time since the 70s, and they're coming online now, which is a really exciting opportunity from an investor standpoint to start taking some of natural gas liquids out of your natural gas stream and sell them. So that increases volumes, that increases profitability. So there are just a lot of really interesting things happening in the energy space right now from an investor standpoint.
So I guess to summarize, we see the risk as minimal.
Minimal,
so,
yeah.
On a nationwide basis, I would like to point out, and just something, a headline to potentially keep an eye on, in Colorado, there is a fracking ban initiative currently in play. It's yet to be seen whether it'll make it onto ballots come November, but that will be a state issue. But nonetheless, something to keep an eye on from a regulatory perspective. I think just probably one or two more questions here as we near the end of the hour. And this is, boy, I wish I knew the answer. This is a $1 million question, but why was the correlation with oil price so high for MLPs in the downturn, whereas historically it hadn't been the case?
No, I mean, historically the correlation between over long cycles and let's say define a long cycle from 2000 to current, it's under 0.5. I think it's 0.35. So it's a wonderful diversifier relative to oil. They almost move independently. Zero would be completely independent. One would be completely one-to-one. So we've discussed this in previous calls, and it's worth going over again. 2015 wasn't a normal year. So in catastrophic environments, 2008 and for all asset classes on a global basis, 2015 for energy on a global basis. When you get into catastrophic environments, as we witnessed in 08, all asset classes correlations spiked. There was nowhere that investors could have allocated assets that would have saved them money, right, preserved their capital, except for U.S. Treasuries, right? That was the only asset class that went up. Everything else went down. So then the questions were, what happened with diversification? Well, diversification failed is what happened, right? Bottom line, diversification failed because correlation spiked. And that's exactly what we experienced in energy again. We saw, like, it was a mirror of the two. Oil dropped 76% from a different high to low, but the magnitude was 76%. The amount that MLPs dropped was almost to the penny, not quite, but in percentage terms, almost equal. The time it took to drop from peak to trough, almost equal in duration. So it's just when you get in, that was a catastrophic environment in 08 and in energy in 2015, the great energy recession of 2015. So this correlation with oil, I would say that again, if we get into another catastrophic environment, expect it. I mean, we've seen it twice now, in 08, now in 15. We've seen it across all asset classes, and we've seen it in energy. I think there's going to be this correlation. Now, I do want to just one more point on this, because it's really important. MLPs are operating companies that can grow their distributions, and it's not price of commodity times volume, which is going to grow my distribution. So after 08, coming out of it, oil prices ultimately start to reach a band, and they're going to trade within a band range based on marginal cost of production. And MLPs, because they are a different business model and are growing their distribution, oil flatlined again. And didn't flatline, but started to move across a band, up and down within this band range, but MLPs continue to appreciate. So from the trough to the peak, MLPs were up 5x. And that's incredible. $1 million became $5 million over that period of time, right? So, but oil didn't go 5x, right? Oil doesn't have that capability to go 5x. And so that's where you get the low correlation over time. So again, I think MLPs lower for longer on energy prices because the U.S. costs are coming down so dramatically. Oil has a new range, and north of 50, I think, personally, I think everywhere in the States is pretty profitable at this point with current drilling technologies, every basin. And so, you know, you start to look at oil from, is it 40 to 60, is it 50 to 70? Yeah, those are probably more like the ranges. You peak a little bit above and maybe a little bit below it. Yeah, over time, clearly you will. But that becomes the lower for longer. It's not peak oil. We're not looking at 250, which was just a couple of years ago, if you remember, because we didn't have enough oil. So it is, I think it's very important to say correlation spike in catastrophic environments. I would expect that to happen again. You'd be a fool not to think that. But also, there's a decoupling now on the upside. Oil doesn't need to continue to go up for MLPs to go up. Oil just needs to get to a point where there's production levels coming back in, which these slides were arguing today, that we've reached that point now. We're starting to see an uptick in rig counts, an uptick in production hasn't followed yet in the United States, but that will come, and then there's going to be even further opportunities for experts in the space that understand the right basins to be in, that see where there's going to be ethane extracted from natural gas, where there's going to be more volumes and more profitability. So it's an exciting time to be in MLPs. It is the bottom line right now, and we think that the correlation that peaked is now going to start to break down again as oil starts to stabilize around these levels.
Great. I think that's a great place to leave off for today. So just want to thank everyone again for joining us on today's call. Just as a reminder, a replay of the webinar will be available over the next couple of days on our website, www.yorkvillecapital.com. Thank you once again for joining us, and we look forward to the next time we speak next quarter. Take care.
Have a wonderful summer.